Patrick, tell me the differences in interest rates one person would pay for a typical bridge loan versus a typical conventional loan.
Okay, well, in general, you're going to find that a bridge loan or a hard money loan is going to be more expensive than what it would be to go into a conventional loan. The best way for me to describe why that is almost all of us are familiar with companies like 7-Eleven or convenience stores on the way home. You need to get a gallon of milk. Well, you can walk inside, they're going to have a gallon of milk, but they're not going to have everything that a typical grocery store would have. So you pay for the convenience of being able to go and pick up just that 1 gallon of milk. Well, a conventional loan versus a bridge loan, the main differences are the conveniences of how easy a bridge loan is. A bridge loan, in our case, most of our bridge loans close in about 2 weeks from the time that you show it to us, the time that we can take a look at the property and say, we're interested in doing your deal. 2 weeks later, you're on your way. Has anyone ever seen that with a conventional loan or conventional bank? Well, currently, right now, Fannie Mae and Freddie Mac, for example, take about 90 days. They always tell you about 60 days, but I've never seen one close in 60 days, and I'm sure anyone in the business sitting out there has not seen one of those either. Banks will sit out there and they'll be 45 to 60 days. Well, in our business, and business being hard money loans, bridge loans, we understand that a flipper or someone that's coming into a program makes their money by being able to deploy their money. So if you can go through the process of getting a loan with us faster, then we understand that you might be able to deploy that money 2, 3, maybe even 4 times a year.
Sure.
So you're definitely going to be much better off if you're having to borrow money, you're going to be better off with a hard money loan if you know that there's other product to buy that you can put your money into. If you're someone that's a developer, if you're someone that is a flipper, if you're someone that's a remodeler, we all understand what the time value of money is. So the conventional loan is going to be less as far as what the interest charge, but we actually think that it's more because by the time you get that loan, we've probably already flipped out of our first hard money loan or we're already onto the second. The second thing that's an advantage of a hard money loan versus conventional is that let's just say that you found a second property. You've purchased the first one and you're already making improvements, but it's not quite finished, for example, but you want to buy your second one. We look at combining those assets and that we will make an extension or we will give you more money off those loans by combining them. Show me a bank that does that. Show me a conventional lender that does that. It just doesn't happen. So those are kind of the main differences and kind of the differences in conventional loans versus hard money loans.
Thank you.
You're welcome.